I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network. Brad, important question. Have you ever eaten a crab apple?
Yeah, we had crabapple trees in our backyard when I was a kid in Denver. I used to climb up and eat them all the time. As I understand it, I was little, but
Do they ever taste good? Or
n
always sour?
no idea. I think they're always tart,
Yeah,
but
I think
that
so
was a
too.
long time ago.
Yeah. So my point is they're pretty worthless. But the reason I bring it up, I was going for a run the other day, and there was a stray crab apple in the middle of the road I just did not see, which is on me. My left ankle, or my left foot landed on one, completely rolled over, sprained my ankle badly, and I'm on crutches. And it just made me think, what is the point of crab apples? They're so small you can't even see them, or at least I can't at my advancing age. And yeah, now the 10K I was training for the end of this month is out the window. So I was just trying to figure out what the purpose of crab apples was, and but I guess it did nourish you as a child, so that's
It's
something.
it's a long con to slightly derail your plans to run a 10K. Nothing broken though.
No, but
That's good.
yeah, sprains enough to keep you, you can't really walk on it for a couple of weeks, and the rate's close enough where I can't do it. Oh well. Um, anyway, yeah, crab apples, of course, everyone knew that was going to be the leading topic, but let's get to what else we're going to talk about today.
Yeah. Now that we've covered crab apples,
Yeah.
we are going to talk about the government shutdown. We are going to talk about some activity from private equity. EA has a big buyout. There's rumors of Target maybe pursuing a take private deal. We talk a little bit about healthcare stocks, and then Carl Delfeld of Cabot Explorer is going to join to talk about international stocks, and we're going to get some input. He had a specific angle. Chris, what was that angle again?
Well, he's talking about that globalization continues is just in a different way that it
Mm.
has been. A lot of times, I'll let him get into it. I'll ask him about it when he comes on.
All right. So we have that to look forward to. We'll come up after the break. Before we get to all that, though, Chris, your week to defend the hottest take you could think of. I like this one because it seems measurable.
Mhm.
Uh, if Q3 large cap earnings growth is north of 8% specifically, the rally will continue. You have 90 seconds and you may begin.
All right, so why I chose 8%. So the last, let's see, one, two, three, four, five, six, 7 quarters dating back to the end of 2023 have been north of 8% among S&P companies, large cap companies. Double-digit growth in each of the last 2 quarters, 12%. Excuse me. Yes, 12% in second quarter, more than 13% in the first quarter. What's expected this quarter is 7.9%. So that's part of the 8% calculus. Wall Street likes earnings beats, and actually expectations were lower than that last quarter, and came in at 12%. Why why these last 7 quarters are significant? This bull market really started technically at the 2022 October 2022 bottom, but it was famously thin through 2023, and it really didn't take off until 2024 and this year. And that sort of aligns with earnings growth being north of 8%. The 4 quarters prior to that, earnings had backtracked, were down. And so in order to extend the rally at such elevated levels, I think we're going to need some earnings beats. It's going to need to come in at least in line with what it has been in previous quarters, and it's going to need to be that 7.9% mark. So hence 8% above. That's it's going to take to extend this rally.
All right. I mean that will be one for us. Like we'll be able to check that easily. I like that.
Yeah.
Yeah, I guess because like if we're priced for perfection, we've said we were priced for perfection a long time. I mean, like, yeah, it stands to reason then that we're going to need to see stocks keep delivering
Yeah.
at those high levels that have been established.
Yeah.
I'll be curious, obviously we'll get more into sort of picking favorites and stuff like that later in the episode, but there has been, I mean, the AI thing is obvious, right? Like I wonder if people are going to care about earnings growth there with
Mhm.
just as much money as flowing into the sector. And then the companies that have like clear sort of government backing and government sponsorship outperforming, like will earnings matter there? And then in the aggregate, is that enough to set a benchmark level for the indices as a whole to hit? It'll be interesting to see how it plays out.
Yeah, yeah. I mean, if I'm being honest, like earnings have come in well ahead of expectations the
Yeah.
last, at least the last couple quarters. 8% might not do it. We did have the worst growth of the last 7 quarters has been 8.24% in the second quarter of 2024, and then 8.7% growth the third quarter of that year. But, after 2 straight quarters of double-digit growth, anything south of double-digit growth possible might not be enough given where the index is already and given where valuations are right now. But, I guess you could also argue that there's been so much talk about, recession potential and tariffs impact on, leading to a recession. And the more quarters people see that we're far from a recession, or at least see that, corporate earnings are still holding up nicely, the less that fear uh, will exist. And, maybe even just 8% will be enough. So we'll see.
Yeah, I feel like just, anecdotally that if we were seeing high single digit or low double digit earnings growth from, I mean, predominantly large cap stocks, right? Like that's where all the earnings growth is right now. I think that certainly soothes concerns that I would have about
Yeah.
the ability to sustain a longer rally, right? Because that's the potential weakness is that is this rally unsustainable because consumers are spending less or people are feeling it in their pocketbooks a little bit more.
Yeah. Okay, let's get to our big three. Number one, government is shut down as of this week, at least parts of the government. You had some good stats on this from past government shutdowns. Clearly, the market doesn't care right now. Stocks are up this week, new all-time highs as we speak. Um, but there's certainly going to be a breaking point when it could matter to the market. When that is, I mean, maybe some of the stats you have tell the tale of when investors do care, but it seems no one's too worried about it right now.
Yeah, that's 100% true. So the data for this originally came from the oft quoted Ryan Detrick of Carson Group.
Hmm.
They had looked at the government shutdowns going back to 1976. Average length was 8.2%. Average S&P 500 return during a shutdown is 0.3%,
Hmm.
with an average return of 12.7% 12 months after the end of the shutdown. The most recent one is probably instructive because it happened in December of 18 into January of 19.
Yeah.
Lasted, Carson Group has 34 days uh, as far as how long it lasted. S&P returned 10% during that time, and it was also a period of sort of Fed rate change policy implementation or Fed rate policy implementation change. So the market as a whole does not sweat these shutdowns.
Yeah.
Obviously, this is a little bit of a different environment because federal policy is a little bit more chaotic, right? We see the federal government investing in more companies individually. We see tariffs being implemented. There's a much heavier thumb on the scale of the economy. But when it's all said and done, the market just rolls with it. We continue to be in a bull market. Um, Obviously, we lose a little bit of granularity with data reporting, right? Like today, we were supposed to get the Bureau of Labor Statistics jobs figures, which we didn't receive. But I think investors go
Maybe that's the reason they let the government shut down. Anyway, go
what
ahead.
I mean, yeah, like if you don't
Galaxy
test,
brain thought, but yeah, go.
yeah, if you don't have the numbers, nothing bad is happening.
Right.
But but like we can sort of make do with incremental data points. So ADP payroll showed 32,000 jobs lost in the most recent figure, and actually revised down September's gains. Was a 54,000 job gain down to a 3,000 job loss, right? So it continues to paint a picture of a weakening labor market. The Fed has already made it abundantly clear that they are going to defer to the labor mandate over the
Yeah.
inflation mandate, right? Like they've come out and they've said very specifically our concern, our downside concerns are on the labor side of the equation, which is in favor of rate cuts, and that's continuing to drive the bull market. Uh, and if we're not getting data to challenge that, so like maybe next month when CPI comes out, if the government's still shut down, it'll be a different story. But for the time being, if this incremental data that we're getting is continuing to paint a weakening jobs picture, then we should expect to see rate cuts. And if we're going to expect to see rate cuts, then no reason really for the market to reverse course and head lower. I
Yeah.
think there's obviously bigger risks to the rally, like valuations, et cetera, than Fed policy. So if they're going to continue on, nothing to really sweat.
Right. Yeah. And yeah, I mean, I mentioned the earnings growth at the top. As long as that, if you have, earnings growth north of 8% or higher, uh, combined with, Fed rate cuts, those are two pretty powerful tailwinds that are enough to counteract, I mean, unless the government shutdown went beyond earnings season or something, which would be pretty extreme. But I don't think anyone thinks that.
Yeah, that does, I mean, it does raise a question, right, of somebody like I think Lithium Americas recently uh, got had a government stake, right? That was a couple of days ago.
Yeah.
Um, those will presumably be fewer and further between, right? We saw it with MP Materials, we saw it with Lithium Americas, saw it with Intel. Presumably, and I say presumably because we've never really had this sort of nature of government direct investment. Um, Presumably that will slow down with a government shutdown. I don't I don't know for certain, because it's not like we have a lot of data points to draw from. So there may be a little bit less of that, but yeah, I don't. I think it's going to take something coming out of left field to really risk derailing this,
Right.
at least until we
Yeah.
get, as you said, into earnings season.
Okay, let's move on to this is totally shifting gears, but EA, Electronic Arts, the popular gaming company, bought out for $55 billion this week by the Saudi Sovereign Wealth Fund, as the Saudi government continues to try and curry favor with the West. Um, and man, I don't have any major takeaways with that, but there's a bigger buyout potentially coming down the pike, rumored to be, and that's Target. I mean, first, do you have any thoughts on the EA buyout?
A little bit. So the terms of the buyout, 210 a share for EA. It's 55 billion. I think it's the largest leverage buyout in private equity history. It's we have seen Cliff write about what he has taken to calling the great consolidation,
Hmm.
where you're seeing bigger companies get bigger. Obviously, I think we talked last week, fewer stocks in the market than ETFs now because private equity is getting bigger and bigger. Um, there were announcements that with this take private deal, which is still subject to shareholder and regulatory approval, but is the stock is priced as if this is going to go through. I think it's trading at somewhere around 201 or like 205 right now, and at 210 a share, that's a 4 or 5% discount to the take private price. Um, that looks like it's going through. There's no reason to expect regulators to get in the way. I mean, that's not the style of this administration. Um, they did announce as part of it that they would be looking to leverage AI to cut costs.
Yeah.
So, I mean, I do think we can see. or we will be able to see, I guess, in the coming years, whether that's an effective mechanism to become more profitable.
Hmm.
Right? Like you leverage AI to write narratives, do voiceover. Like there's all these little components to game creation that are fairly replaceable with AI. NVIDIA had um, a press conference or as one at one of their developer conferences or something like that. They talked about using the NVIDIA architecture to basically run non-player characters where you just have them as like AIs that exist in games. So this is sort of a natural extension of what we have seen with actual success with AI, which is a little bit of productivity improvement, cost-cutting mechanism, but not really materially changing how the companies are doing business.
Yep.
Um, and it's more the same, right? For the good and the bad. It's private equity gobbling up more stocks. It's cost cutting as the profit driver rather than innovation, I suppose. Uh,
Yep.
the other rumored private equity deal was Target.
Yep.
Allegedly, Fox Business had shared some rumors that there may be a take private deal for Target. These rumors have come out in the past, but they did replace their CEO effective February 2026. These rumors have sort of been circulating since May, and the I I I don't know that I have a much larger takeaway other than we're obviously in an environment that is facilitating mega deals
Hmm.
and is favoring well-heeled investors and private companies over public companies.
Yep.
I don't necessarily know that Target is a great candidate to take private. Like we saw Sears Holdings. I don't know if, I mean, this would have been almost 10 years ago now, but Sears Holdings, when they were sort of circling the drain as a brand, their real estate assets were sort of a feather in the cap of the investment. And Target has 250 million square feet of retail space, but it's a $40 billion company. So it's not like the Target has underperformed for a while now.
Yeah.
Um, but it's not as if you're buying retail real estate for pennies on the dollar. I personally think the rumors are, if not I don't think they're unfounded. I think that there is speculation around it, but I don't see a lot of immediate room for opportunity to take somebody like Target private. Like if they're under new ownership, that'll change maybe the company culture a little bit, but is that going to save a retailer that's been struggling in an environment where costs remain high and Target is sort of a mid-tier retailer that's not offering the discounts of a Walmart or the cachet of your higher end brands. So I would be surprised, I think, if there actually was any kind of acquisition announced for Target.
Yeah, it did seem surprising to me. Target, by the way, last 5 years, stock down 44%. Um, peaked in late 2021. Uh, and it's like a third of that price now. Um, so yeah, it has not been a good stock for a while. I mean, a lot of those losses in the last year, down 40% in the last year, but um, yeah, that struck me as EA getting bought out is one thing. Target seems like it would be. I don't know who'd be making more of the mistake, the company that's buying it out or Target itself going going private. But I guess
Yeah,
you look at those stock returns, then it wouldn't seem like as much of a mistake. But you know, it could be a turnaround candidate at some point, I suppose.
yeah, and EA has an obvious sort of cost-cutting, fat
Yeah.
trimming value to it. It's like, look, we can make games cheaper. AI there's plenty of AI slop floating around out there, but the things that it does well does sort of lend itself to taking a high-flying risk on a game company and looking for efficiency improvements, and maybe divesting yourselves of some of the assets, make games cheaper, I struggle to construct a narrative like that with a big retailer like Target.
Yeah. Okay, moving on just quickly to our third item before we bring on Carl. Um, Healthcare stocks, which were the one sector that were one of the 11 S&P sectors that was down for the year, at least prior to the last week, up more than 7% in the last week, and led by Pfizer in particular, which this is we've talked about government, federal government getting involved with certain companies. Well, here's the latest one. Um, so. On Tuesday, Trump administration reached an agreement with Pfizer, which involved the company voluntarily lowering its domestic drug prices in exchange for a 3-year exemption from tariffs targeting the pharmaceutical industry. Pfizer pledged $70 billion in U.S. manufacturing and research as part of the deal, according to CNBC. And Pfizer stock up 16% in 2 days after the announcement. Um, Cliff wrote today about healthcare stocks because they've been so beaten down, being a potential opportunity. And the tariff point, exemption from tariff point is the big one there as far as healthcare stocks go, is sort of a cloud being lifted there. I'll talk a little bit more about that and why that could, make healthcare stocks a good place to invest for the first time in a while.
Yeah, the tariff sort of threat was a sort of Damocles for a
Yeah.
lot of these companies, because the president had said we're going to make drugs 1,400, 1,500% cheaper,
Mhm.
had threatened tariffs, and we did get news last week, I believe, that the tariff rate for pharmaceuticals was going to be for branded pharmaceuticals, and it was going to be 100%, but they were going to offer exemptions for companies that were building facilities in the US or investing in the US. And that actually covers like the majority of big pharma companies. Eli Lilly obviously was a big pharma winner after the GLP-1 sort of breakout story. They already have plans to expand in the US. A lot of these drug manufacturers do. And now with the push to offer sort of, I don't know if it's just generics. I seem to have that as a point that I'd come across, but with the push to offer direct to consumer drugs at a discounted price, uh, it seems very favorable. Like all the overhangs have been removed. It seems like it's just going to be business as usual. And, it is an alternative to government subsidies of healthcare costs if, right, like there are two ways to get drug prices lower for consumers if you're the government, one of which is to subsidize the price. The other is to what the White House has been doing lately, which is um, essentially demand that drug companies offer most favored nations pricing, implement something like a direct to consumer, like the Trump RX website, whatever that'll end up looking like. I've been trying to load it for a few days and have not been able to do so. I guess it doesn't exist right now. But that's probably more, I don't know if it's more business friendly, but it's not unfriendly to pharma companies if you're saying, look, you're just making less of a margin on this. We're not going to punish you. But if you're willing to work with us, then we're going to continue to facilitate your ability to sell pharmaceuticals in the US. And we're not going to punish you for it as long as you're willing to play ball. I mean, that's been a recurring theme
Yeah.
this entire year is you can do really well with us if you play ball.
Right.
And I think we're starting to see that with healthcare stocks now.
Yeah, and with healthcare specifically, I just even taking the federal intervention out of it, as Tom Hutchinson has written ad nauseum, he always has several healthcare stocks in his Cabot dividend investor advisory portfolio. The aging of the population is a trend that's not going away. People need healthcare,
Yeah.
and with the, you know, baby boomers reaching senior citizen age where they need more healthcare. People, as they age, always do. It's going to be something that's more and more in demand. And healthcare strikes me as, a sector that just it can only stay down so long, regardless of who's in the White House. And now it seems that who's in the White House might actually be helping or might be starting to help healthcare. But it seemed like a turnaround was inevitable. This may be the start of it.
Yeah, yeah, like you said, it was the one underperforming sector, was the only net negative return year to date. So you had these overhangs that were serving as a drag on the stocks, but counterbalancing that was these tailwinds like the aging population. And now that those anchors are gone, the tailwinds are sort of taking full effect, and they're doing a little bit of catch up rallying. I mean, obviously, like one of the sort of novel technologies that AI has sort of shown some proficiency with is like new drug and materials
Yep.
discovery. That would be like a meaningful growth driver um, that I would be looking out for if I'm looking at individual stocks is some of this new novel drug development. Um, CRISPR, which is not AI related, but is a novel gene editing technology. I mean, if you can couple that with some machine learning or whatever and start devising, they just had a like a cure for HIV, right? Like we're
Yep.
removed it at the cellular level. Like there are actually really exciting developments happening in the healthcare space. I think it's definitely a sector to pay attention to.
Yeah. Real quick before we welcome on Carl, I just wanted to mention today's offer. If you go to cabotwealth.com/street, we are offering Cabot Money Club, run by Nancy Zambell, who's been on this on podcast several times. We're offering it for 75% off the normal price, $49 for the year. That's like less than a cup of coffee per month, basically. So super cheap. It's Cabot Money Club. You get monthly issues, and that includes the stock of the month pick, which is selected from one of our other advisories, in which Nancy has a stock picked for or picks a stock from one of our other advisories, and then interviews the analyst of that advisory. There's sort of extended Q&A about the stock and their strategy. You also get premium reports, a richer retirement, ETFs, an easy way to build a lifetime investment portfolio. Nancy has a lot of ETFs in her portfolio, which is not something all of our advisories have. And then you get access to the entire library of Cabot Money Club magazines and all past stock of the month issues. So again, Cabot Money Club we're offering for $49 for 1 year if you go to cabotwealth.com/street. Okay, we'll take a quick break and we'll welcome on Carl Delfeld. All right, welcome on Carl Delfeld, Chief Analyst of our Cabot Explorer Global Investment Advisory. Carl, thanks for joining us. Um, I I wanted to have you on because I really liked what you wrote about in your issue yesterday. You have weekly issues come out every Thursday. You talked about sort of the new globalization. You wrote. Globalization is not dead by any means. It has just changed its stripes and is now more between regional blocks such as Southeast Asia and Greater China. If I was to build a global stock portfolio right now for a 2025 to 2050 timeframe, it would likely be balanced between America and emerging markets. Can you just expand on that and what I guess what you're seeing because you have an extensive background, overseas background, particularly in Asia. Um, what are you seeing right now?
Well, thank you. It's nice to be with you. Yeah, I think maybe the place to start is the topic that I keep returning to, probably more than you would like, and that's the U.S. China rivalry.
Yeah,
And that's kind of where it starts because the U.S. and China probably 45% of the world's GDP. I mean, the rivalry is getting more and more intense. And I'm sorry to say, because obviously I want the U.S. to win the rivalry, China is gaining ground. Um, and you can kind of see a sign of that by the trade negotiations, so-called trade negotiations. The Trump administration put on very stiff tariffs, and China did not even blink and
right.
push back with rare earths, and now they're not buying soybeans, uh, and that's a sign that they're confident that they are gaining. Um, and we could spend hours on this, and I could anyway.
Yeah,
All the areas where they've leapfrogged the U.S., different industries. So it's really should be so clear that this rivalry is going to be the dominant issue of this decade and maybe decades to come. So I say that because China's exports to the US have fallen, but they're growing everywhere else. They're growing to Europe, they're growing to Southeast Asia, to other emerging markets. So uh, they're still an export machine, and so the capital flows and the trade flows are just shifting. So there's no way globalization ends. It just changes, and if a very simple way to do it is to follow the money.
Right.
And and that's even happening with the markets. For example, you've seen it even with the two or three Chinese picks I have in the Explorer portfolio. They've just exploded this year,
Right.
and that's because in part the AI, the AI, with Baba and other companies are on the AI bandwagon, and China is just a little bit behind the U.S. in terms of AI, a little bit behind in semiconductors, but they're catching up fast. So you're seeing that even in the marketplace, stocks. So I don't know. I mean, so I guess my advice to your listeners and our subscribers
Yeah.
is to watch these flows and take profits uh, where you can, given that stocks are pretty highly valued,
Right.
and diversify a little bit. You don't need to do any big changes, but add some stocks from different sectors in different countries around the world.
So, Carl, what?
Yep.
So you do write about Southeast Asia a lot. Just talking about the changing
Yeah.
dynamics, right? Like the dynamic that I think, well, certainly everybody in my generation is accustomed to is the U.S. essentially outsourcing manufacturing to China,
Yeah.
and in exchange, right, we maintain sort of a dominant intellectual portfolio, like IP
Yeah.
position. What does that dynamic look like? Not necessarily between the U.S. and China, but what does like the China to Southeast Asia dynamic look like over the next
Yeah.
however long?
Well, Southeast Asia, the reason Southeast Asia has intrigued me for so long and why I went out there early this year to three or four countries there is that, it's a collection of ten countries in a very strategic part of the world, between, just off China, off India. So Southeast Asia, basically it's south of China, east of India, the two biggest countries in the world. So they're perfectly positioned for these trade and capital flows. That's the first thing. Very young populations, consumer growing, well educated. And you have your finger on one big issue is that China is not a low cost manufacturing center anymore. You know,
Mhm.
that's why it's not just the tariffs that have forced China to relocate some manufacturing to Vietnam, to India, to Malaysia, to Thailand. It's been going on for a long, long time. It's just going a little bit faster. So China's moved up the scale, so to speak, so that their chief advantage is not labor anymore. It's more the whole manufacturing industrial ecosystem, uh, shipping. I mean, you name it. They've built the whole supply chain. They're a supply chain superpower. So that's the way I would look at it. And the only other thing I would say about China, and it took me a while to figure this out, but China really is two countries. It's 1.3 billion people, right? But it's really a 500 billion country, uh, advanced, well-developed country. That's the way you got to look at it. It's two countries. 500 billion is very advanced, well-developed, and the other eight, 800 billion is an emerging market country. And they sit next to each other.
Right.
Yeah,
And you mentioned that the new globalization, emerging markets sort of benefiting.
yeah,
You mentioned Southeast Asia. I imagine that's where
yeah.
some of the emerging markets you're talking about are. What are there others specifically that you
Sure.
have your eye on?
Well, I would say first in Europe, I mean, this is kind of I read this the other day and I had to blink twice and read it a couple times to see if I got it right. But Poland's Poland has been a star in Eastern Europe. Poland's per capita GDP is now higher than Japan's.
Wow.
And it really is a strong country. So Europe, even uh, the Scandinavian countries, Denmark, Finland, these countries are very well run. I mentioned, I did some recommendations regarding Switzerland, which is a very great. Now, that's obviously not an emerging market country, but I'm just saying that. So Europe, I really would not discount at all. And the valuations are lower there. And the other place I would look is South America, Latin America.
Yep.
And I don't know if you saw this, it's not officially released yet. It was a little bit surprising to me, but the Defense Department puts out this strategy paper every administration,
Hmm.
and it has been focused on China, the U.S. China rivalry. This year, it's shifting to South America, which surprised me.
Yeah.
So now we have this North America, South America focus. It's kind of in line with the new administration's sort of sphere of influence strategy. Um, I find it a little bit puzzling, but I've been talking to people, and there's more and more activity in South America. Some of those countries, Brazil, of course, is the big one. Brazil's like almost half of South America when you think about it,
Right.
but
It's
Argentina's having its problems, but there's other places there. And then Mexico, um, I mean, Mexico is a great emerging market despite all the headlines and everything and the drug issues and so on, the cartel issues. Uh, its manufacturing base is gaining. And by the way, China's investing in Mexico in a big way.
Yeah, I remember Mexico had been when,
Yeah,
under the prior administration when there was an emphasis on sort of near shoring and finding
yes,
sort of um, friendlier sources, sort of post-COVID supply chain crunch,
yeah,
that had been a priority. Is the Department of Defense, well, Department of War strategy
right.
document, is that a concession that China has become out of reach, or that we,
Yeah,
because like you think about something like green tech or like solar, like photovoltaic manufacturing and deployment. I mean, obviously we haven't seen much of we've seen a pullback in the US's investment in green tech and
yeah,
clean energy.
right.
Are we just nationally, I guess, saying, okay, well, you guys can have this domain, right? Clean tech, robotics, that can be the domain of China. We're going to focus on something that's geographically within our sphere of influence. And I guess I'm asking if there's more than a U.S. concession to like entire sectors in
Yeah.
that report you were referencing.
Well, that's been the issue. I mean, China, I mean, when you look at it, China comes out with these 5-year plans. I think they're coming out with their 14th 5-year plan, which is kind of crazy. And this morning I thought to myself, they have a 5-year plan. We have a government shutdown every 5 years,
yeah.
right?
Yeah.
There's the difference. But yeah, I mean, what's concerning is China is able to mobilize and focus on a sector or multiple sectors and then just pour money and support into it, which is their strategy. So you brought up like EVs, for example. I mean, EVs, everybody's almost given, the US has almost given up on EVs, right?
Yeah.
The GM CEO yesterday said, well, we're going to downshift in EVs.
Yep.
So China, BYD, but they have 100 EV companies going at it right now. And there's probably going to be 5 or 6 or 7 that survive. So China has intense competition within a sector. Local governments get involved, everybody gets involved, and they keep driving the price and quality, price down, quality up. So now they produce more than half of global EVs, 80% of solar panels. What else? Wind turbines. They basically clean tech. They've almost captured that market, and now they've almost captured EVs. They have a small EV called the Seagull. which is selling for under $10,000.
Right.
And apparently it's a great car. I mean, I
That,
mean, so what I worry as an American is what Brad just said is then I wonder to myself, okay, if we're going to let all these markets go and we're throwing in the towel, what are we going to do? What are we going to make?
right. You mentioned the shutdown here in the
Yeah,
US, so doing that here every
yeah,
5 years, which is about right.
yeah.
Clearly, the market hasn't seemed too concerned about it yet. What is your concern level, and do you think there will be sort of a breaking point for the market if it drags on past a certain point?
Yeah, I mean, when you really think about it, we don't want to go into politics. I mean, certainly partisan politics, but part really my personal view is that our problems are not really economic, they're political.
Yeah,
And I think the reason the stock market's not reacting much is because in a weird way, Washington is decoupled from Wall Street.
yeah,
I mean, I think Wall Street and corporate executives just say, okay, you guys just it's just not working. There's not much we can do, so we just have to kind of deal with whatever you guys throw at us. Rather than in the old days, they would have gotten involved
right,
and help form a consensus and kept things going on. But business is sort of decoupled, and business is not aligned. Big business and especially Silicon Valley and big tech, they just react. Whatever administration, I mean, just think about it. It doesn't matter who gets in every 4 years, they just have to deal with it,
right,
right? And so that's why I think, I mean, the main thing for me with the shutdown shows is the debt issue. And that's what I think everybody should hopefully pay more attention to. The debt is really spinning out of control. And the interest on the debt now is about 15% of our budget. Think about that. 15% of our budget just goes to paying interest. Now, when that gets to 20 and 25, that's going to be a big problem.
right.
Yeah.
Brad, did you have something?
N- I guess, is there, I hate like looking at this through the lens of maybe a country in decline.
Yeah.
Where do you see us as standouts still? Where do you see us as leaders?
Oh, okay.
I guess sector
Yeah.
wise, right? Obviously, we're concerned about sort of the investment angle on it, but is there a
Hmm.
sector where we're going to continue to excel if we're,
Yeah.
innovative
Well,
tech is, sorry, go ahead.
no, 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 go ahead. I'm sorry. I didn't mean to interrupt.
Oh, so if innovative tech, if we're sort of conceding that segment, um, that had always been sort of our leadership position, is that we
Yeah.
had the brightest minds and the newest developments and the newest technologies. If that's gone, what do we have left?
Yeah.
Where's the sector where the U.S. is going to
Yeah.
outperform? Is where your dollars being invested in
Yeah.
U.S. based companies is fully justified.
Well, I think, the market's smart. You can't really fool the market. And look at where the capital and the stocks have really taken off over the last 3, 4, 5 years. It's software companies, right? Software companies, the platform companies like Google, Amazon. I mean, they're more logistics. There's tech involved, but it's not making things like making like the laptop I'm on and you're on. I mean, that wasn't made in America, right?
Right.
That was made in Mexico or Taiwan or Vietnam or some place like that. So that's the concern is that we lost our industrial base, and that includes technology. Now, software companies like NVIDIA, classic, right? They design software. I mean, it's very technologically advanced, but they don't actually make the semiconductor chips, right? They're made in Taiwan through
Right,
TSMC, Taiwan Semiconductor,
Right.
which has been a pretty good stock, TSM. So those are the companies that's the stocks that have shown growth. So that tells you where our strength is. The question is that enough? Is that too narrow a sector? Um, and now we're trying to catch up, like Taiwan Semiconductors coming to Texas to build a semiconductor plant. in Phoenix, excuse me, Phoenix.
Right.
But is it one or two generations behind what they make in Taiwan? And they're facing training problems. They're bringing people, they have to train people and everything. So, and the manufacturer. So anyway, I don't mean to be too pessimistic, but we're struggling now to catch up, which is, where that's why in my book, Power Rivals, it's America and China's superpower struggle.
Yeah.
Well, each party has problems and challenges, and they're struggling. U.S. is struggling to stay a superpower, and China is struggling to become one.
That's a good way to place to
Yeah.
end it. And yeah, I was going to mention your book. What did you say the full title is again?
Power Rivals.
Power Rivals.
Yeah.
That's you can find that on Amazon, I'm sure.
Yeah.
And yeah,
Mhm.
and also you can always read more from Carl at Cabot Explorer on the cabotwealth.com website. Carl, really interesting stuff. Great insights. And we had Larry Chung on here a few weeks ago to talk about China specifically, but it's good to look at, some other opportunities out there that are beyond just, the U.S. China um, rivalry. And then you framed it in a really good way. So thanks for joining us today.
Thank you. Good to be with you.
All right. And thanks
Thanks,
everyone for
Carl.
joining us on Street Check.